open and agnostic to opportunities. When you're coming at a landscape, first of all, recognize if someone's doing a great job. And if someone's doing a great job, go and invest or back them. Don't try and do a Me Too approach. But similarly, be open-minded about where opportunities might lie. And don't let artificial constructs or legacy approaches be a hindrance. So be willing to run through the walls if the walls are what's blocking a better product, a better process. And be agnostic about that. I came to my current role having from a consulting background, from a private equity background, having looked at multiple different verticals and multiple different industries, and being willing to look at that full range of opportunities. We looked at a highly complex underwriting and insurance process, and we really focused on what are the levers that are driving the entire process. We looked at the complexity in terms of the insurer or underwriter and agent relationship, which creates sort of a feedback loop that makes transactions slower and more complex. And we decided we needed to unify that and come up with a one-step, straight through underwriting process. So that's the driver of us being an exclusively direct company. We looked at what drives price. And in a market in which historically prices have been set by a single group operating under an antitrust exemption, we thought that the straightforward way to set prices was to listen to our clients, to look at the process, to look at the cost, to look at the drivers of risk, reduce risk where we could, reduce cost where we could, and turn that benefit back to our clients. So in many ways, we took a pretty straightforward approach to each of these problems, stripping away 150 years of legacy inertia. We took a hidebound industry that really has seen very little innovation in the last 150 years, and we looked at what's driving that. One of them is cost, and we looked at what is the opportunity to lower cost. This is an industry in which all of our competitors have exactly the same rates across the board, and we actually stepped in and for the first time for commercial transactions and transactions of all sizes, filed lower rates that actually bring the acquisition and financing costs down dramatically, full 25% less expensive for most large transactions. Secondly, we're the only exclusively direct company. So in an industry which has historically marketed its products and distributed its product through independent agents, we thought it was important to completely control the entire process, the underwriting process, which makes it smoother, faster, quicker for all of our clients. And finally, we wanted to put a balance sheet that looked the same as or even larger than most of our largest competitors behind each of our policies to make sure that our clients had world-class protection. And so we did that through a creative use of reinsurance to protect each of our policyholders. We actually do a lot of market research, and we've certainly seen a decline in some of the activity in the higher end luxury space. This isn't rocket science. We actually, when we do a lot of sort of statistical analysis across the industry, so although our business is still growing at a triple-digit growth rate, when we look at where actual real estate transactions are coming, we've actually seen a really sharp decline, much sharper than I think people are talking about. At the same time, a lot of our commercial clients are starting to see some hidden opportunities. They haven't seen as many broken deals as you might expect, but the amount of interest in, for example, when we put together some pretty interesting sort of crowdsourced market data on where vacant properties are, there's a tremendous opportunity there, and there's a lot of interest. So we've seen a lot of developers looking for the off-market and starting to find the off-market opportunity.